All right, everybody, we are here with Tatiana Ivleva-Lopez from Prosperity Mortgage for this week's Mortgage Minute. And we're going to continue our conversation about strategies for how to handle the increased interest rates. But first, Tatiana, what's going on with the market?
Hi, everyone. So the week of September 15th to 22nd, 30 and 15-year fixed interest rates increased slightly. So for the week, the major announcement was from Fed reserves that they kept the rate the same. And, they held it steady, but also they indicated that there's still a possibility of another hike before the end of the year. So let me share the screen so I can show you this little chart right here. Can you see it?
Mm-hmm.
Yes.
Yep.
Okay, so we have a dark blue is conforming rates, and light blue are jumbo. Those are over $1.89 million in our DC metropolitan area. This purple, I guess it's purple, right? It's a FHA loan. So the rates went up slightly. Last week it was around 7.18%. So we do see some increase. So looking ahead, all eyes on upcoming November 1st meeting of Federal Open Market Committee, or Feds, as we know that. Some predict that they will increase the rate. About 28.7% of forecasters predict that rate is going to increase, and 71.3% predict that rates are going to remain the same. So, but none of them expect rates to decrease.
I was going to ask you that. No one expects them to go down.
Okay.
Not as of right now, no.
Okay.
Okay. So I noticed that since the rate stayed the same with him the Fed not raising the rates, but I noticed that the rates did tick up a little bit. So what's the mechanism behind how that happened?
Right, that's a good question, because a lot of buyers, they think whatever the Fed say, that's what is going to translate whenever they talk to their mortgage lender, and that's not always the case, right?
It's really not the case. It's more just because our rates, they did not really depend on federal, whatever Fed does, but whatever comments they make, what they predict for inflation to go up or to go down, that what drives the mortgage rates up or down.
Okay, because the mortgage lenders try to get ahead of what they're predicting. Is that right?
Correct, exactly.
Okay, that makes sense. We do have a regularly asked question from buyers, and I'm hoping you can go into it in some detail that maybe we can't for everyone, and it is discount points. Well, I know it's a handy tool for these higher rates that they can use to lower them a little bit, but what are they and how do they work?
Okay, so it's a very good question, and a little bit of glossary. So discount points is a charge to permanently buy the interest rate down. So you can get interest rate without paying anything for it, or if you want your rate to go down, it to be reduced, you pay points. One discount point equals 1% of the loan amount. Half a point, 0.5%, and so on.
Okay.
So I actually prepared little PowerPoint presentation so I can show you, how it translates, and interest rates and monthly payment. And what we do as mortgage consultants, we show the clients, all the options, and we show rate with points, rate without points, how much it costs, how long it takes to recuperate from the cost of it, and then they make educated decision.
Okay.
Does it make sense to buy or not?
Okay.
So let me do that. I'm gonna share my screen again, and I'm gonna do real fast.
Yes.
Like this. You can see the blank screen, right?
Blank screen,
Yep.
yes.
Okay, so let's just look at this scenario. 500,000 sales price, 20% down, so the loan amount is 400,000.
Okay.
Let's say the credit score is 740, first time home buyer. Just right away, I'm gonna tell you the rates, they could vary slightly depending on, you know, how much person makes, and there's different things that could change the interest rate. But look, for the example, I'm giving this rate 7.375% today with 0 points. Principal and interest payment is $2,762.
Okay.
Okay.
So let's say we're buying a point down. The rate is gonna go down to 7%. So 1 point, which is 1% of the loan amount, $4,000, buy the rate down by 0.375%.
Okay.
And principal and interest payment is $26.61. Monthly savings $101.49. Then the break-even point, we'll look at 39 months or 3 years and 3 months.
Okay.
Simple math, $4,000, the cost of the point divided by monthly savings.
Okay.
So now it's going to be a question, how long we're going to keep the property for,
Yep.
right?
Right.
Or is this $100 crucial in monthly savings for you to have, you know, to pay the point? Because everybody needs to understand and know what their maximum comfortable payment is. We don't want anyone to be house poor, right?
Right.
So that is important factor as well. So let's say another example, we're gonna go a little bit higher in the price.
Okay.
So let's do $1 million price range, 800,000 loan amount, you know, the same scenario, 20% down. It's a little bit different bracket. When we go above 726, 200, the price in the loan amount, it's high balance conforming loan limit. So a little bit different rates as of today, 7.25 with 0 points. Principal and interest is 54.57.
Okay.
Paying 1 point, $8,000. It goes down to 52.55, 200 and roughly $2 monthly savings. Break even point, actually the same, 3 years and 3 months.
Right. Right.
Yeah.
So
Yeah.
that's what we look at, and that's how we analyze to see
Okay.
what happens. And sometimes every rates change every day, right? So sometimes 1 point can buy the rate down by even 0.5%. I've seen instances when the rate was lowered by 0.875%, and then
Oh, wow.
it kind of becomes a no-brainer to buy the points.
So
Right.
it's not always 1 point equals a 0.25% reduction in the rate. It
No.
can vary based on the.
Exactly. It fluctuates every day.
Okay.
And sometimes, you know, you don't need to pay the whole point. Maybe you'll pay 0.75% of a point to get to, the same reduction. So it changes, it varies.
Okay.
Okay, that's very, very good to know. And you know, I've seen some buyers when, you know, a lot of buyers, they like to shop their loan with other loan officers. And they'll get a quote from one and then say, oh no, this one they're offering, let's say they get the 7.375 from one, and they're saying, oh no, I'm gonna go with this other lender because they're offering 7%. And it's kind of like, how do you do that? But then when we urge them to get the actual loan estimate, not just the quote, but the loan estimate, and we see that the loan officer has actually factored in a discount point that they'd have to pay that they didn't discuss with the borrower. Have you seen that when people bring you loan estimates? Have you seen and then had to tell them, oh, well, that's because of a discount point, and they're surprised?
Exactly. You know, it's a very good point, Kelly, because when you shop for a rate for a mortgage, you don't just look at the rate and bottom line, right? How much you need to bring to the settlement. You need to look at the rate and the cost of the rate. And the cost is that discount points. Also, you want to see at how much lenders charge of origination fee, or sometimes they break it down to underwriting fee and processing fee,
Right.
to make it look that it's less. But when you combine underwriting and processing fee, it could be a lot of money. And so that's what you look at when you're comparing one quote to another.
Yes.
And that's what I do when clients come to me and say that somebody else gave me better rate. I ask for the estimate, because I will see right away, are they charging points? What are their origination fees? Sometimes they charge 1% origination fee and 1% in discount points to get the rate down by 0.25%, right?
Yeah.
So, and then I'll tell them, okay, well, I can do the same if you want. It's gonna be more expensive.
I mean, I can do that.
But
Right.
that's what you need to look at.
I do think that's one of the reasons we love working with you so much, is because the less scrupulous loan officers, it's kind of smoke and mirrors. They say, oh, I can give you that. And they don't give all the details. You really have to compare apples to apples. And you've always been very straightforward with our clients and very just showing them exactly what's going on with their loan. And I think that's one of the things that everybody needs to look for in their loan officer.
And that apples to apples is the loan estimate to loan estimate, not the pre-approval quote and all these other things, because there's no lock, there's no disclosure of all of the costs until you get that loan estimate. Is that correct?
Absolutely, yeah, that's
Yeah.
correct. Yeah, thank you so much for the compliments. It's true, I think transparency goes a long way. A lot of people, they don't understand it. They don't buy houses every day, so
Right.
I want to educate them so they understand what they actually signing up for.
That's
Yeah.
exactly right. It's not their fault that they don't know, because it's not their world. This isn't their job.
Yep.
But yeah, so it's our jobs to take responsibility and show them everything. So,
And I just need to throw out there that it's also important that your lender's available outside of office hours, not
Yes.
Monday through Friday, 9 to 5. Okay, that's a whole rabbit hole.
we bother Tatiana all the time, even when she's on a boat somewhere out of the country, and she always replies.
Yeah.
24/7.
That's right. That's right. All right. Anything else for this week?
That's it for me.
Okay. How about you, Tatiana? Anything else?
That's it. I just
Okay.
want to wish everyone great weekend, and I'll see you next week.
If anybody wants to find you, what's the best way for them to reach out to you?
They can contact me at 571-245-3000.
Okay, perfect.
Very good.